Alphabet Inc. ticker symbol GOOG is currently trading at $192.77 a share. It's down about 5% since their earnings, and we're going to be going through those right now. This is the fourth quarter and full year results for 2024. Alphabet revenues in Q4 increased 12% year over year to $96.5 billion. Google services revenues increased 10% to $84.1. And Google Cloud revenues increased 30% to 12, and that is growth with the Google Cloud Platform, AI infrastructure, and Gen AI solutions. Operating income increased 31%, and operating margin increased 5% points to 32%. Net income up 28%, and earnings per share up 31% to $2.51. So everything is looking good. So you can see why is the market reacted poorly? Well, here we have the Q4 results. And then the prior quarter, Q4 of 2023, the prior year results, and then we have the full year here as well. And then what we're going to be doing is looking at my automated stock valuation spreadsheet, looking at Google's financials and seeing if there's a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, although Google only has 1 year of dividends, so I won't be looking at that, and of course the Ben Graham formula for intrinsic value. So let me just quickly go here. We've put in the ticker. Google loads up all the latest data. $193 a share, 2.3 trillion in market cap, a PE ratio of 25, which is even lower than the S&P 500 average, which is at 30.42. Earnings per share, $7.72, a beta of 1, meaning it's just as volatile as the market, and analysts say it's a buy at $271 a share. Dividend, 0.39%, which means you get 75 cents per share. It's a very safe dividend, $4 billion they pay, and in terms of the net income and free cash flow payout ratio, it's 4 and 6%. Buy before the 9th of March you want to get paid. So we have the numbers here. Let's have a look at revenues. Don't look at the trailing 12 months because this includes everything. So 2024, $384.96 billion, all-time highs. And if we look back here, we can see $350 billion, up from the prior year. Revenue on the quarter beats the prior year. Everything is up. If we scroll down here, we can see this is the revenue split. So we have the quarter ended 23 versus 24. Google Search and Other up 48 to 54 billion. YouTube ads up to 10.4 billion, up from 9.2. Google Network down slightly. The entire advertising up 65 to 72. Subscriptions up. Google Services in total up, as we can see. Cloud up. Everything is basically up, as we can see. Even employees are up, which is good. So yes, revenue at all-time highs and growing. Next, we'll have a look at the net income. As profitable as they've ever been, 100 billion in profit. You can see here, this is all-time highs. They've gone steadily growing. If we go here, you can see basically this is the total income from operations. Everything, once again, is up. Well, apart from the smaller things, some slight loss on other bets and Alphabet level activities. But the main chunk, which is obviously Google Services and Cloud, are up as well. Let me just see if I can go down here. I found the free cash flow at the bottom. Where was it? There we go. So we'll move on to the free cash flow. Free cash flow, all-time highs, 72.76 billion. If you look on the quarter there, 24.8 billion. So everything is up massively. Where we have net income from operating activities. Where is it? Net cash provided, up massively. CapEx, purchase property and equipment. You can see here, CapEx is up massively. Now, if we do go back to my sheet, look at operating income versus CapEx. See, they have a massive CapEx in 2024, but free cash flow is up. Operating cash flow is up massively. So despite the CapEx being high, they're definitely okay because the operating cash flow is so high. Shares outstanding. There's some splits here, so it doesn't look correct, but you can see they're buying back the shares, rewarding shareholders. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, their future free cash flows and discounting them to today's value. So based on averages currently, it's put at about $174 a share. One thing already is the weighted average cost of capital for Google is 9.13. Normally I would do it a bit lower, which would be 8.5, and that will put it about fairly valuable. But we'll keep it here for now, look at the numbers and see what we think. So net income, 30%. I think that's a fair amount. Revenue growth rate, we're expecting 390 and 434 billion in the coming years. Let's see if analysts agree. Pretty much exactly that. Yep, 389, 342, so pretty good there. Net income margins, I think that's about fair. I mean, really, an average of the last 2 years, 30% again. So then free cash flow, net income, I mean, if we take an average of the last few years, that puts us at about 83%. That's going to be a bit of a difference. $185 a share, but once again, I think this is a little bit on the high side. Discounted free cash flow, I would say, it says it's a buy, about $201 a share. So, yeah, it's not a massive buy, but if we look at how these tech companies are usually valued by a discounted free cash flow model, normally they are not a buy at all, but this is a massive, massive free cash flow generator. Dividend discount model, as I said, we won't look at that. They only have 1 year of dividend, but in a few years, we'll be able to have a look. Ben Graham formula for intrinsic value. Normally doesn't like stocks. Let's see if it does. Earnings per share, it looks at PE of a non-growth company, AAA bond, corporate bond yield. And unfortunately for Google, or for everyone, I suppose, in stocks, is that the corporate bond AAA is now 5.46%. So it is actually increasing. Now, let's see. Oh, let me undo that. Now, let me see if what analysts are thinking for growth on Google. 14%. So Ben Graham doesn't like this stock either. Puts it at about $140 a share. Now, if we were simply at, somewhere in the region of 4%, it would be a buy, but unfortunately, we're at a pretty high inflationary environment still. If you're interested in the sheet, check out my Patreon. Links are in the description. This is the $4 tier. This gives you the access to the sheet, and you can do as many requests as you want. You can look at your own stocks and value them, and it gives you full access as long as you're a paying member. If you want to go the higher tier, you can, or if you want to go the lower tier and just help me out for $1.50 a month, that'd be good. But once again, up to you. I prefer giving you a service and you enjoying that service. And a lot of people are using it, and a lot of people are liking it, so I'm very happy to see. So finally, let's have a look at the comparable company model. This is a way of valuing stocks, looking at their competitors, and the metrics we're looking at sort of at a glance is revenue, revenue growth rate, EBITDA, net income, profit margins, price to sales, price to book, and Peter Lynch's PEG ratios. But then the metrics exactly are EV to revenue, EV to EBITDA, PE, and forward PE. So for Google, the ones that come out immediately to me are ticker symbol Microsoft, MSFT, obviously a leading technology company, cloud, AI, very similar to Google. We'll go with Meta, more social media, but still a pretty apt comparison, and Apple. Now these, if we go, unfortunately I'll do this on another screen, but if we go S&P 500 top constituents, Apple is, well, assuming this is up to date, but Apple is the largest. Google are about the sixth, only Meta, Amazon, Netflix, no, Meta, Amazon, Nvidia, Microsoft, and Apple. So I think these are sort of the direct competitors. Obviously, Nvidia, they're different, but their own thing, but in size. So you can see here, enterprise value. Microsoft and Apple are the largest, Apple being the highest, 3.5 trillion, Microsoft with 3, Meta being slightly smaller than Google. Revenue, Google is second highest in revenue. Revenue growth rate, despite being the second highest, it's also the second highest in growth rate, which is quite good to see, excellent to see. EBITDA, third lowest. Net income, most profitable company. I believe it's probably the most profitable company in the world, or at least in the US. Profit margins, middle of the pack. Apple being the lowest, Meta and Microsoft being higher. Price to sales, market average is currently about 3. 3.12. But if we compare against the competitors here, it is the lowest. Price to book, market average is 5. And obviously this is the lowest as well. PEG, Peter Lynch's price to earnings growth. Ideally we want this under 1. None of these are under 1, but once again, Google is the lowest. So EV to revenue, lowest. EV to EBITDA, lowest. PE, lowest. And forward PE, lowest. It's a buy on all metrics, $244 a share. So I think Google is massively under valued compared to its competitors. Now, if I was going to switch out Meta for, I would say, Amazon, this will probably make everything look better. Let me just load the data here. Yeah, $245 a share. PE, once again, lowest. EV to revenue, not the lowest, but obviously Amazon is, a lot of the revenue is from the e-commerce side, so those numbers are a little bit different to what they are normal tech companies, as the profit margins are about 8%. I would like it if they had AWS as its own separate company, but anyway, what we're going to do. So yeah, $245 a share, and if we were to compare it to prior, I think it put it at about 200, and we'll let this load again, 244. So yes, does look like a buy. Ben Graham says it's not a buy. Dividend discount model, we can't use that. Comparable company model says it's a massive buy. Oop, I've moved that sheet around. Let me put it back. And finally, the discounted free cash flow model, interestingly, says it's about fairly valued or a buy. So very interesting there. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys next time.